Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Oracle.
If you find our talks useful, please consider subscribing, liking, and commenting underneath. Because, folks, today we are unpacking a company that I think a lot of people just stopped paying attention to maybe 10 years ago. We are talking about Oracle. And honestly, if you're picturing, dusty server rooms, old corporate campuses, and Larry Ellison racing sailboats while the tech world passes him by, you are missing one of the most aggressive and frankly shocking pivots in the history of tech.
It really is a complete reinvention story. I've got the Q2 fiscal year 2026 numbers right here in front of me, and they do not look like the Oracle of the past.
Okay.
The headline number, just the top line, is $16.1 billion in total revenue.
16.1.
Yeah, that represents a 14% increase. Now, usually for a legacy company, 14% is, that's a great quarter.
It's respectable, right? But it's not change your entire portfolio good.
Exactly. If you just stop there, if you just read the headline and move on, you miss the actual story happening underneath.
The real story is always in the segments.
It is. The engine here is the cloud revenue. That segment alone brought in $8 billion.
Okay, $8 billion.
And that is up 34%.
34% growth. For a company this size, that's massive.
Yeah.
But I was looking through the notes you sent over, and there's one statistic, one specific number that made me actually put my coffee down. It doesn't seem real. We have to talk about the backlog.
Yes. The RPO, remaining performance obligations. This is, without a doubt, the jaw-dropper stat of the quarter.
Okay, so just for listeners who might be new to this, let's define that. RPO is basically signed contracts, right?
Yeah.
Money that's guaranteed to come in.
Precisely.
Yeah.
It's future money that is legally locked in. It's not a projection. It's not a maybe. It is signed. And right now, Oracle's RPO is at $523 billion.
$523 billion. With a B.
With a B.
It's $500 billion.
Yeah.
That's an economy-sized number.
Yeah. It is. And to give you some context on how fast this is moving, because a big number is one thing, but the velocity is another, that number is up 438% year over year.
Okay, hold on. 438% growth in backlog. How does a company even book that much business in 1 year? Who is signing these contracts?
It's the AI giants. This backlog isn't selling database licenses to banks anymore, the old bread and butter. This is massive multi-year deals with the titans of tech. We're talking Meta, NVIDIA, OpenAI.
Oh.
Everyone is scrambling for compute power. There's a global shortage of the infrastructure needed to run these huge AI models. So they're going to Oracle and just locking in contracts for years.
So it's a panic buy, but for supercomputers.
Yeah.
And that number, that RPO, tells us their revenue visibility is basically locked in for years to come.
Totally. They're selling the shovels for the AI gold rush, and they are completely sold out. And that demand is what's driving the specific growth engine we need to talk about. OCI, Oracle Cloud Infrastructure.
All right, OCI. Their direct competitor to Amazon's AWS, Microsoft Azure, Google Cloud. How did that unit do?
It's absolutely on fire. OCI grew between 66 and 68% in the quarter.
58%.
To $4.1 billion in revenue.
That is huge.
It's huge. And just to put that in perspective, their guidance is targeting $18 billion in OCI revenue for fiscal year 2026 alone.
See, this is the part I always struggle with, and I imagine some listeners do too. You have AWS, the 800-pound gorilla. You have Microsoft Azure everywhere. Google. Oracle was famously late to this party.
Oh, very late.
People wrote them off.
Yeah.
How are they suddenly growing this fast? What's the secret sauce?
It comes down to a very specific and I think very clever tactical shift they call the Switzerland strategy.
The Switzerland strategy, as in neutrality. They're not taking sides.
But precisely, think about it. Amazon and Microsoft are walled gardens. They want to lock you into their ecosystem.
Right. It's sticky.
It is. It creates friction if you want to leave. Oracle looked at that and did the opposite. They embraced multi-cloud and chip neutrality.
So instead of fighting them, they partnered with Azure.
They partnered with them. They went to customers and said, hey, we know you use Azure. That's fine. Keep using it. But take our database, which is still the best in the world, and run it inside Azure's data center.
That is actually brilliant. It removes all the friction. The CIO doesn't have to fire Microsoft, which is a terrifying thought for most people.
Exactly. And the numbers show it's working. Their multi-cloud database business grew 817%.
800%. That's explosive.
Yeah, they have 71 joint data centers now. It allows for seamless deployment. If you're a big enterprise, you don't want to be held hostage by one vendor.
You want flexibility.
And Oracle is leaning right into that. It extends to the hardware, too. That's the chip neutrality part.
Explain that. Because right now, when we talk AI, it feels like it's just NVIDIA's world.
Right, and NVIDIA is king, but Oracle's saying, we'll build a cloud that's optimized for NVIDIA, yes, but also for AMD, also for Ampere. They let the customer choose the best performance per dollar. They're just providing the best garage for whatever car you want to drive.
Okay, but building all of this, I mean, data centers, high-performance chips, the cooling systems, that cannot be cheap.
It is not cheap at all. It's incredibly expensive.
Yeah.
And that's the other side of the coin. They are spending heavily. Capital expenditures is hitting $50 billion.
$50 billion. That's a staggering amount of money walking out the door.
It is. They're essentially doubling their capacity.
Now, usually, a number like that scares investors, right? It eats into free cash flow. It creates a deficit. Why isn't the street panicking?
It can scare people, and we will get to the risks. But in this case, the market sees it as a necessary investment to service that $500 billion backlog we just talked about.
Ah, so it's not speculative spending. It's not build it and they will come.
Exactly. It's they've already paid, now we have to build it. It's execution spending. And despite that massive cash outflow, their financial health is still solid. They actually raised the dividend 25%.
Raising the dividend while spending $50 billion on data centers, that's a flex. That signals a lot of confidence.
It really does. And on top of that, they're buying back shares. Plus, the earnings beat was nice. Non-GAAP earnings came in at $2.26 per share.
I saw that. But to be fair, wasn't some of that helped by a one-time sale?
Good catch. Yes, it was partially aided by a $2.7 billion gain from selling their stake in a company called Ampere. So the headline number is a little inflated, but even if you strip that out, the core business is profitable and growing.
Okay, so fundamentally, growing like a weed in the cloud, mountain of guaranteed revenue, and they're playing nice with the competition. Let's shift gears. What's the chart telling us?
The technical setup matches the fundamental story almost perfectly. It's looking very bullish. We have a classic golden cross on the chart.
I love a good golden cross. For anyone who doesn't stare at charts all day, what is that?
Sure. It's when the short-term moving average, the 50-day crosses above the long-term one, the 200-day, it's considered a really strong signal of a long-term bull market.
And it feels resilient. We saw other software companies like a Salesforce or Adobe get a little wobbly recently. Oracle just kept ticking higher.
It really has. It's like it's decoupled from the old software trade and joined the AI infrastructure trade. It's trading more like an NVIDIA than a legacy software stock.
So if someone's listening and thinking about getting in, what levels are we watching?
Well, if you're looking for an entry on a dip, there is very strong support around $280. That seems to be the floor.
And on the upside, where could this go?
Analysts are getting pretty bullish. Mizuho just put a $400 price target on it. The average on the street is a bit lower, maybe 307 to 310, but the momentum is clearly pushing up.
Are we looking overbought, though? Is the RSI getting hot?
Surprisingly, not yet. The RSI, the Relative Strength Index, it shows constructive momentum, but it hasn't hit that overbought red zone. It looks like it's in an accumulation phase before the next leg up.
You mentioned accumulation. That means the big fish are buying. Who's in this?
Oh, yeah. This is definitely an institutional play. The smart money is loading up. We're seeing big funds like DuPont Capital, Yarber Capital, Miracle Mile, all boosting their stakes.
That's always a good sign. When you see funds like that buying in, they're not looking for a quick flip.
Exactly. Institutional ownership is over 42%. And the general sentiment reflects that. We track a quantitative sentiment score, and it's a 9 out of 10. Overwhelmingly bullish.
9 out of 10. That's rare. Is that just a U.S. tech story?
It's global. We're seeing demand from Asia-Pacific for automation, AI diagnostics in Brazil running on Oracle Cloud. The demand is coming from everywhere.
So the analyst consensus is what? A buy.
It's a moderate buy overall. About 70% of analysts have positive ratings. It's just hard to bet against $500 billion.
Right. Okay, so let's look at the future. What's on the catalyst calendar for the next 3 months?
The big one is earnings, obviously. Q3 fiscal 2026 report is coming up in mid-March.
And what's the street looking for?
Consensus is around $1.72 for EPS. But the interesting part is the company's own guidance, which suggests 16 to 18% revenue growth. If they hit the high end of that, or if that cloud growth accelerates even more, we could see another beat.
Got it. And for income investors, that dividend payout is coming soon.
Yes, the record date was January 9th, so that increased dividend should be hitting accounts shortly.
What about the macro picture? How does the broader market environment play into this?
Right now, it favors them. Any talk about rate cuts tends to push money into growth stocks. But specifically, there's a rotation happening into AI cloud plays. Investors are chasing the infrastructure spending. Oracle's right in that sweet spot.
Okay, I have to ask about the rumor mill. I saw some chatter online about something called Stargate and TikTok,
Yes. Okay. Huge disclaimer here. This is unconfirmed. Pure speculation.
of course.
But there's chatter about a Stargate project, basically building the biggest supercomputer cluster in the world to train the next generation of AI models.
Wow. And the TikTok thing.
There's always talk about Oracle's role. If a U.S. spinoff of TikTok ever happens, they already host TikTok's U.S. data. If a spinoff were forced, Oracle would likely play a massive infrastructure role. Again, nothing concrete, but it's the kind of thing that could cause a sudden price spike.
Interesting. Okay, we have painted a very rosy picture. We have to be responsible. What's the bear case? What could go wrong?
The elephant in the room is the cash flow. That $50 billion capex spend is a lot of money. It creates a free cash flow deficit in the short term, and it increases their debt.
So the risk is they spend all this money and then the demand just dries up. The AI bubble bursts.
Exactly. If companies decide in 2026 that AI isn't worth the cost, Oracle is left with a lot of expensive hardware and a lot of debt.
That's a scary thought.
Yeah.
But the backlog.
And that's the counterpoint. That $523 billion backlog is the safety net. They have contracts. The demand is legally obligated. It gives them a buffer.
That RPO number really is the anchor for this whole story.
It is. The other risk is legal. There's a class action lawsuit about undisclosed AI debt needs. It's something to watch, but the market mostly sees it as noise compared to the growth.
And I suppose if the whole tech sector sells off, Oracle gets dragged down too.
Correct. Sector weakness is always a risk. But as we saw, it's been more resilient than its peers because it's seen as an infrastructure play.
Right, let's wrap this up. Final verdict. We've looked at the numbers, the strategy, the chart, the risks. What's the score?
I'm giving Oracle a bullish score of 9 out of 10.
9 out of 10. That's high confidence. Give me the elevator pitch.
Forget the old Oracle. This is no longer a legacy database company. It's an AI infrastructure giant. They have a $523 billion backlog. They're growing their cloud business at nearly 70%. And they have partnerships with OpenAI, Meta, NVIDIA, all the big players.
And the long-term targets.
They're targeting $67 billion in total revenue for fiscal 2026 and aiming for $144 billion in cloud revenue alone by 2030.
So the strategy is pretty clear.
Buy now for the AI infrastructure dominance. This isn't a trade for a week. It's a multi-year hold into that 2027 to 2030 acceleration window.
It's just incredible to see a company of this age pivot so hard and so successfully. It goes to show you're never too old to learn new tricks, especially when those tricks involve $500 billion.
Absolutely. The Switzerland strategy seems to be the winning ticket.
Well, there you have it, folks. Oracle isn't the dinosaur you might think it is. It's the engine room of the AI future. We hope this analysis helps you navigate the market. If you enjoyed it, please make sure to subscribe and leave us a comment. We love hearing from you.
Thanks for listening.
See you next time on Smart Wealth with Joshua.